Well, welcome, ladies and gentlemen, to another installment of the Trader's Edge. Today, we're going to be talking about COMEX Shanghai Gold. It's our first anniversary update. We launched it in October of 2019, so we'll get a look at how it's done. Quick disclaimer, remember futures and options, they involve the risk of loss. They're not suitable for all traders, so do your homework. All right, gold now has three major trading centers. New York and London were the key centers for trading gold for a long, long time, both the physical and the futures markets, as well as the London-New York gold arbitrage, the over-the-counter market. But in the last 20 years, Shanghai has now become the largest physical gold trading center in the world, and it did so in a remarkably quick time. China is the largest producer and consumer of gold, about 25 to 30% of all global demand. So it made sense to launch contracts to better connect the world's largest derivatives exchange, CME Group, with the largest physical market, Shanghai. And we listed contracts, Shanghai gold contracts. They're offered in both US dollar and the Chinese currency, renminbi. So here's the chart out of the gate till now for the last basically year. And you can see out of the gate we did well. We were doing a fair amount of volume. Open interest was growing. And then the pandemic hit, and volume in all major contracts around the world, the major financial centers dropped over the summer and early fall. But then late summer, early fall, we started to see recovery. August, September, we saw volumes actually double and open interest skyrocket. So obviously there's interest in the market. It's rebuilding, and we look for more of the same in the future. What we have here on this slide is from CME Direct. It's a front-end trading system that the CME Group offers. The top panel is the Shanghai Gold Future, but in CNH terms, or the Chinese renminbi currency. The bottom panel is the Shanghai Gold contract in US dollars. And you can see we have, in both contracts, we have the December, February, and June. We also have a couple calendar spreads, DEES Feb and DEES June. And you can see the markets there. The bid-offer spreads are relatively narrow. The quantities, the size is 12 up. So good markets, you can get orders done. And volume and open interest isn't always the indicator of liquidity. The best indicator is usually the bid-offer spread, the tightness of it, and the quantity bid and the quantity offered. All right, so let's look at the two and compare. In a year dominated by gold's rise to all-time highs and regional dislocations in the gold price, the onshore market has not been spared any excitement. It's true, all the metals markets around the world have not been spared any excitement. While the Shanghai gold benchmark price typically trades at a premium to the COMEX gold price, 2020 has seen the Shanghai gold benchmark price at a steep discount to the COMEX contract, the regular gold contract. The charts on the following pages will show this. We're currently at a $40 discount. The spread had gone as low as a $100 discount. So you can see this shows the black is the COMEX Shanghai US dollar gold contract. Black's trading above. It's at a premium. And then it goes to a discount. Black goes below the COMEX gold. Very interesting. The next chart's a little bit better, though. It actually just shows the premium or discount. And you can see for the first 7 or 8 months, Shanghai had a premium. And then for the last 6 or 7 months, Shanghai's trading at a discount. So what are some of the reasons for this? Lack of physical demand in China, plus the onshore gold supply recovering quickly. The lack of physical demand was, something during the pandemic, especially, and the supply and demand was all out of kilter during the pandemic because mines were shut down and demand was shut down. So it's very interesting. The divergence in monetary policy between Chinese central bank and Western central banks, and real interest rates have diverged. Real interest rates are a key component into how precious metals trade. All you have to do is go back to 79 and 1980 when real interest rates skyrocketed. Gold went parabolic from 200 an ounce to 875 an ounce, and it was pretty interesting. Strong rebound in China's economy, also removing the safe haven bid. Gold is known as a safe haven in times of tumultuousness or uncertainty, but a strong rebound in the Chinese economy removes some of that uncertainty. Other uses of the COMEX Shanghai gold contract, you could trade Shanghai gold versus other listed gold contracts onshore for any short-term dislocations, spreading all sorts of strategies available. You could trade Shanghai gold for the FX arb too. So you can be long short the US dollar Shanghai gold contract, the US dollar versus the Chinese renminbi version, and vice versa. Well, that carries an implied FX rate, okay? So if that rate is substantially different than the actual, currency rate, the dollar renminbi rate, there's a possible arbitrage trade. These are big trades, a lot of significant trading in the arb between products, the implied rate, FX rate, and the actual currency rate in the interbank market. And you can do it via futures. You can, we have a Chinese renminbi currency at the CME Group, and so this trade is possible. To wrap up, I want to call your attention to cmegroup.com/education, where our institute is, a lot of online classes, and a lot of things that'll help you sharpen your skills and help you advance your learning curve. So thank you all for listening, and remember, do your homework.